We've got a really interesting document to dig into today, a new circular from SEBI, India's securities regulator, and it's all about some pretty big changes coming up for equity index derivatives.
Definitely a big one. This could really shake things up.
Yeah, and we know you're familiar with derivatives, but this circular, well, it impacts everything. How options premiums are paid, what kinds of trading strategies are allowed, even the contract sizes. So are you ready to unpack all of it?
Absolutely. Let's dive in.
Okay, so first, imagine a super intense trading floor. Screens everywhere with constantly updating data. That's the world of equity index derivatives. We're not talking about individual stocks here. We're talking about contracts based on whole indices like the Nifty 50. High stakes, really fast paced, and now a whole new set of rules to play by.
And it's a market that's exploded in popularity. Indian investors are really active in derivatives, using them for everything from hedging risk to, well, trying to get bigger returns.
Which is exactly why this new SEBI circular is so important. It seems like they're stepping in to manage this quickly growing market, trying to find that balance between encouraging participation, keeping things exciting, but also making sure it's all stable and, well, safe.
Right. You can really see the themes of risk management, investor protection, and overall market integrity all over this document. It's pretty clear SEBI is taking a very hands-on approach to shaping how derivatives trading will work in India going forward.
All right, so let's get into the specifics of this circular, break it down into those 6 key changes SEBI's put forward. First up, upfront option premiums.
Definitely a big one.
Yeah, so starting February 1st, 2025, anyone buying options, get ready to pay that premium right away. No more delayed payments.
This is really about managing leverage risk, making sure that option buyers have the funds to cover potential losses right from the start.
So no more sort of playing with borrowed money. You got to have the cash ready.
Precisely. It's going to encourage more responsible trading, especially, I think, for newer investors who maybe they don't fully grasp how options leverage can work.
Makes sense. And speaking of managing risk, this next change is going to be interesting for anyone who likes, those expiry day plays. We're talking about the new restrictions on calendar spreads on expiry day. Also effective February 1st, 2025.
Yeah, going to be some adjustments there.
Big time. Just a quick reminder for anyone who needs it, calendar spreads. They involve holding options with different expiration dates. And, well, things can get pretty complex, especially on a day like expiry day when, things are moving fast.
And that's exactly why SEBI is stepping in. They're limiting those calendar spreads on expiry day to reduce the chances of, I'd say, confusion, miscalculations, and ultimately to avoid people taking on too much risk without realizing it.
Trying to make expiry day a little less of a roller coaster.
I think that's a good way to put it. They want to curb some of those riskier trading strategies that tend to pop up around expiry day.
Makes sense. Okay, so then we come to another change that's really focused on risk intraday position limit monitoring. Starting April 1st, 2025, SEBI is going to be keeping a much closer eye on just how much trading any one person is doing within a single day.
Right, because this is about maintaining order in the market. You don't want a single trader building up a position so big that they can actually disrupt how the market's functioning. Think of it like, guardrails on a mountain road. They're there for everyone's safety.
Right, to stop things from going off the rails. So we've got upfront premiums, restrictions on those expiry day calendar spreads, tighter watch on intraday positions. It's clear SEBI wants people to really think before they trade.
Yeah, it's almost like with each of these changes, SEBI's saying, slow down, think about what you're doing, make sure you really understand the risks.
Absolutely. It's a definite shift in tone. They seem to be prioritizing the long-term health of the market over, those short-term gains that come from super fast trading and people taking on too much leverage.
Right. Less gambling, more investing. Exactly. And that brings us to another really interesting change, one that could have a big impact on who can even participate in the market. Starting November 20th, 2024, we're going to see bigger contract sizes for index derivatives.
Interesting. So bigger minimum bets, essentially.
Yeah, and this one stirred up a lot of conversations. Some people say, look, larger contract sizes are going to make it harder for smaller investors to get involved with index derivatives. Those higher capital requirements could price some people out completely.
Yeah, I can see that. But couldn't you also see this as a signal to institutional investors? Like, hey, India's derivatives market is growing up. It's becoming more sophisticated.
For sure. For those big investors who really care about stability and transparency, this move toward bigger contracts, it does make the market look more appealing. It suggests things are becoming more regulated, more predictable, less of a free-for-all.
So maybe less exciting for the day traders, but potentially a big draw for pension funds and those long-term investors.
That's the idea. And this actually connects to another change that suggests SEBI wants to encourage those longer-term strategies, the simplification of weekly index derivatives, also effective November 20th. They're cutting back on the number of weekly index options that are available, basically limiting those super short-term bets that people can make.
Right, so less opportunity to just roll the dice every week and hope for the best. It's fascinating to see how SEBI is using these changes to kind of nudge investors in a certain direction, encouraging a less volatile, more fundamentally driven approach.
It's a clear trend, and it's not just happening in India. This push for more regulation, more transparency, tighter risk management in derivatives markets, it's happening globally. Regulators all over the world, they've learned some tough lessons from past financial crises, and now they're taking steps to make these markets, well, tougher, less likely to collapse when things get crazy.
Right, so this SEBI circular, it's not just a local story, it's a window into how the whole world of finance is changing.
Exactly, and that's what makes it so interesting to follow. These changes, they give us a glimpse into the future of derivatives trading, not just in India, but maybe everywhere.
It really makes you wonder, with all these changes designed to protect investors and make things more stable, does that make the Indian derivatives market more attractive to you personally, or less so? It's a question worth thinking about, especially if you're interested in this whole world of global finance. We'll definitely be keeping a close eye on how all these changes play out, and we'll be back soon with more deep dives to the ever-changing world of finance. But until then, thanks for joining us.